Hello everybody, Economic Ninja here. I want to talk to you today about oil, okay? And we're seeing a huge narrative that keeps popping up here. Checking my recording, all right. That is leading to much higher oil and fuel prices, okay? Now we've talked earlier about how Goldman Sachs is calling $100 per barrel of oil, and this is when oil was in the low 60s. We are now in the mid 70s, and I believe, and Goldman believes, that you're going to see $100 barrel of oil by midsummer. So if you want to give a date to it, I'm looking between the mid-July to early August timeframe. That is going to increase fuel, I believe, nationwide higher than the all-time high of $4.20. That was set, I believe, this is all memory, June 17th, 2008. Okay, guys? This is going to add to a lot of very serious issues in the economy by the fall. So out of the hedge, I'm going to link the story below. Goldman doubles down on oil. Says ignore OPEC plus drama. World desperately needs an extra 5 million barrels to avoid critically low inventories. All right. Now I'm just going to paraphrase here. The OPEC meeting was a complete disaster, okay? They failed to come to any kind of conclusion or what they should be doing. And we did see the price of oil fall, right? Now, it didn't fall a whole lot. We're looking at between, what, $77? And it really doesn't matter, to be honest with you, because this is just short-term noise. It says right here, picking up on this development, Goldman's commodity strategist, I'm going to mess that one up, Colvarian, who has been extremely bullish on oil in the recent months, concedes that while this lack of agreement has introduced uncertainty into the OPEC plus production path, its base case remains for a gradual increase in production through first quarter of 2022 that would ultimately help meet their preferences, with Brent prices at $80 a barrel this summer. Looking ahead, Goldman predicts that as negotiations continue, most outcomes will be, one, still imply higher prices in the coming months as the physical market tightens, and two, with higher OPEC plus production than the group discussed needed by the global oil market next year. That said, Goldman warns that the price volatility will likely rise, which can be clearly seen in today's violent reaction, which saw West Texas Intermediate surge, then slide, with the release of the August OSP, the key next catalyst. Now, guys, remember, we're talking futures. If companies that depend on oil start to feel that things are getting a little nutty, that the market's getting tight, and we might be running into a shortage, they will run to the futures market and they will buy futures. This is what we saw with lumber. And there was a panic, and lumber exploded higher. It was like a 4x multiple. And I believe that you're going to see that again. I actually believe the futures will go over $100 a barrel in a panic because they want to lock in prices, especially companies that are dependent on oil to keep their production, their company moving. They're going to lock those prices in, okay? And once it starts really moving up, like I believe it already has, we're going to really see it tick up, all right? But here's this. But the most important observation in the Goldman note, and remember, guys, Goldman, they're very smart people. They don't just publish this stuff because they don't want to be known as the bank or the investment firm that is wrong. They want to be known as the guys that are right. So you need to be paying attention to what the big boys are saying, okay? Their note is that OPEC plus drama notwithstanding, the world will still be in trouble unless an additional 5 million barrels in production emerge by the year end. To wit, while the threat of a new OPEC plus price war is no longer negligible, its negative price impact would be dampened by a global market starting in a 2.5 million barrel deficit and in need of an extra 5 million in production by year end to avoid critically low inventories. Now let me sum that up. Goldman understands, just like myself, and I'm sure many of you, that these governmental agencies, these regulatory bodies, are always slow to react. They're slow to move. They aren't proactive, they are reactive. So where you have the money guys on Wall Street going, hey guys, there's a deficit. These other ones are just bickering about who gets more per barrel, who gets to produce more that year. Okay, it's all politics with them. Before you know it, they're in a dilemma. Now, if you think about it, is it truly a dilemma when you are pumping oil out and all of a sudden the price rises and you're not pumping a bunch out? Sort of. Let's say you're pumping out 10 barrels of oil a day. Let's just round numbers. And it's selling at 74, but all of a sudden there's a panic and it's $100. Are you sad? Well, true, you are sad because you wish you were pumping out 20 barrels of oil at 100. But the facts are, you are still getting $100 a barrel for your 10 barrels of oil. So you're happy. And you also know that, guess what? Down underneath that hole in the ground, there's still another 10 barrels of oil that you're going to be able to sell tomorrow. And you can always ramp up production then, okay? So it's sort of a win-win scenario as we move into these higher inflationary times for oil-producing countries. However, what's really going to happen, and this is where they don't usually expect it, and you're going to get this info on the Economic Ninja channel, is as the price of barrel rises, and these companies or countries are super excited, the shareholders excited, the end consumer is not. And what happens is, as the price explodes, and it costs more to fill up your gas tank, guess what the consumer does? They slow their spending, and they stop buying that much fuel because they stop going on vacations. And then it hurts the economy all the way around. And that's when you have panic. And you could sell oil all day long at $100, $130 a barrel, but who cares if nobody's willing to buy it? So I believe that is going to be the end result in this scenario. I believe we're going to see huge volatility in equity markets, all kinds of markets, because there's going to be a deflation bubble or an inflation bubble that's about to be popped because people are going to stop spending. And when they do, it's going to seem like overnight. Hope you guys got something out of this. It looks like my OBS studio is overloaded. Hopefully it still works. If not, well, we'll see you next time. The Economic Ninja is out.